Hello students, in the previous video we have seen, we were studying this topic Introduction to Companies Act, under which we had covered this two topics, that is Basics of Company Law and Introduction to Companies Act. Moving further with the topic, the definition and characteristics of company, we are going to go ahead with this topic today. Okay, so what is the definition of the company? Is it defined under the act, or we just need to check out the general meaning? So it is, yes, it is defined under the Companies Act under section 2 clause 20. Okay, 2 clause 20. Okay, and this is one thing that I want to tell here, that whenever section 2 is read under any section, then this particular thing will be called as clause, section 2 clause 20. But if I talk about, for example, section 21, this, okay, this is suppose section thing. So section 21 clause 20, this is not called as clause, it will be called as section 21 subsection 1. Okay, and but when it comes to section 2 of any act, then it will be said as section 2 clause 20. Okay, here it is said as subsection, here it is said as clause. Okay, always remember this. One second. Okay, so what is the definition given here? One second. The company means company incorporated under the act or under any previous company law. What do you mean by word previous company law and company incorporated? So we need to understand it word by word. Company means a company which is incorporated under the act. Which act? Companies Act 2013. Incorporated means which is registered under this act. How the company is incorporated under this act, we're going to see in the section 7 of this act in further chapter, further course. Okay, and so whenever a company is registered under Companies Act, it will be considered as company under Companies Act 2013, and on such companies, provision of Companies Act 2013 will prevail. Okay, that company need to follow this particular act. Okay, and or means a company incorporated under this act or under the previous company law. What was the previous company law? It was Companies Act 1956. Okay, Companies Act 1956. So this was the previous company law. So any company which was registered under this act would also need to follow Companies Act 2013. What does this mean? Okay, so what does this mean is a company which is registered after commencement of Companies Act 2013, and any company which is registered with the previous company law, both will have to follow Companies Act 2013. Now, a company may be an incorporated company, that is which is registered under this act, or a body corporate. Body corporate means an LLP. Okay, body corporate means LLP or foreign company, or exact definition we'll see in later on. Okay, now an incorporated company, what is it? It is a legal and artificial person which is distinct from individual forming it. So incorporated company is, I had already told you, is a company which is registered under this act. Okay, it will, after registration, it will become a legal and artificial person which is separate, that is distinct from the individual forming it, that is the shareholders, okay, or promoters who form that company. So that resultant company, that is the incorporated company, is different from the promoters. Okay, now whereas what is unincorporated company? Unincorporated company means a partnership form. On partnership form, Partnership Act prevail. If it okay, and not the Companies Act. Okay. Now, therefore, unlike a partnership, a company is a corporate body and a legal person which has a status and personality which is separate from the members constituting it. Means in partnership form, partners and partnership form are considered as same entity. But in company and shareholder, or you can say promoter, these both are separate people. It is an natural person and it is an artificial person. Okay. Company has same right as of citizen of India, and shareholder and company will be considered as a different person. When we talk about company, it does not mean that we are talking about the shareholder who are owning it, or when we talk about shareholder, it does not mean, it means about the company which is there. So both have the separate identity. Okay. Now also a term body corporate has come. So what do you mean by body corporate? It means a corporate entity which has a legal existence. It has a corporate entity which has a legal existence. Okay. So it may includes a private company, public company, one person company, small company, LLP, foreign company. Means every kind of company comes under body corporate. Also it will include LLP, foreign company. So any company which has a legal existence which is governed by Companies Act or governed by any other law. Okay. So you can note this down by taking its screenshot. Okay. Moving forward, when you incorporate a company, it has some characteristics which is distinct from sole proprietorship or partnership form. These are independent corporate existence that we had already discussed, that by incorporation under the Act, the company is vested with corporate personality, that is separate legal entity. Please note this word, separate legal entity, for this particular point, that a company has its own separate legal entity which is distinct from the members who compose it. Okay, who forms it. So the personality of a particular member is not merged with a company. Company has its own legal existence, has its own separate identity. Okay. Then second is limited liability. Upon incorporation of a company, the members' liability becomes limited, or it becomes restricted to the nominal value of shares taken by them. That is, it is the members' liability. Means in case of partnership firm, sole proprietorship firm, we all know the liability of the owner is unlimited. But under this, liability of members becomes limited to the value of shares, nominal value of shares which is taken by them, or the amount guaranteed by them in case of company limited by guarantee. Okay. So it's written that upon incorporation of company, members' liability becomes restricted to the nominal value of shares taken by them, or the amount guaranteed by them. So number of shares in case of a company limited by shares, and the amount guaranteed by them in case of company limited by guarantee. What are these things? We'll discuss in the further slides. Then no member is bound to contribute anything more than the nominal value of shares held by them. What does this mean? It means that only the amount they had agreed to contribute, either by way of shares or by guarantee, only that for that amount they are liable, nothing more than that. No one can attack their personal asset in case the company goes into liquidation, okay, or insolvency, or any fraud has been conducted. Okay, in any case their personal liability will not occur unless that particular person has done some fraud. Okay. And third is perpetual succession. It is a very important point, as in case of sole proprietor, if the sole proprietor dies, the sole proprietorship also dies. It also get dissolved in case of partnership form. If all the partners dies or if one of the partner dies, then partnership breaks. But in case of company, an incorporated company never dies like this. Okay, if the promoter, all the promoters got dead, then also the company will not die. It has to die in a legal way only. The legal way is winding up. It does not, company can not come to an end just because its promoter got dead. Okay, so it's an entity with perpetual succession. What term we use here is perpetual succession. So you have to remember this term. Perpetual succession means the membership of a company may keeps changing from time to time, but that does not affect the company's continuity. Okay, the death or insolvency of individual member does not in any way affect the corporate existence of the company. Now, in above this first point, this is a case Solomon and Solomon, in which this thing only was written about separate legal existence. Okay, and in this case, Gopalpur Tea Company, they had talked about perpetual succession. Okay, and the last point is separate property. Now, as I had said that company has a separate legal existence, the company has its separate legal entity, so company is the only owner of the capital and assets owned by it. Its shareholder have no right over the company's property until the company goes into winding up, and then also there is a certain various provisions, procedure after which the shareholder get the right over the company's asset. Okay, so if in a layman language, company can purchase any asset in its own name, and shareholder generally has no right over those property. It is the company's property, and no one can show his ownership on those property other than the company. The company is the real person in which all its property is vested, and by which it is controlled, managed, and disposed of. Means company can control that, manage that, and dispose of that property. It's all the right regarding this is with the company only. Okay, and this thing is given under case Bacha F. Guster. Okay, then fifth point is transferable share. What does it mean? That the shares of the company is freely transferable. So and if you talk about private company, there are certain restrictions, but still you can transfer it amongst the members. So you will get more liquidity in this. Okay, and what its return is, incorporation enables a member to sell his shares in open market in case of listed company or a public company, and to get back his investment without having to withdraw the money from the company. In private company also you can transfer your share, but there are certain restrictions and the procedure that is to be followed, and we're going to discuss it in the further slides. Now this this provides the liquidity to the investors and stability to the company. Now another benefit is common seal. What is that? It is a features. Basically earlier common seal was a mandatory thing. It was kind of official signature of the company, but now this requirement has been removed. It is an optional thing. If company wants to keep its common seal, it can. If it don't, then it is fully on the company to follow this provision or not. Okay. Now, after this amendment, in case the company does not have common seal, the authorization shall be made by at least 2 directors. Okay, or if 2 director is not available, then by a director, that is 1 director and 1 company secretary. Okay, wherever the company secretary has to be appointed by the company, because there are certain provision, certain types of company only who has to appoint company secretary. So if they have CS in their management team, then a director and a CS can sign a particular document where common seal was earlier required, or any 2 director can be sign those. Okay. Now, this is very important topic from examination point of view, as a short note may come from this. Okay, this is lifting of corporate will. So, what does this say? That the phrase lifting of the will, what does this phrase means? That looking behind the company as a legal person. That is, the company is actually the company is here. Okay, and this is the will. You can say called as a curtain. Okay, and these are the shareholders and directors. Okay, so these are behind the curtain and company is in front. So everyone deals with company directly, but on behalf of company, as company is an artificial person, company has no mind, no brain, so all the work for company is done by these people who are shareholder and director of the company or management of the company. So whenever some fraud happens in the public interest and at large, so the court lift this particular curtain, which is called as lifting of corporate will, and court will directly come to these people and make them liable for the act that they have done. Okay, so the phrase lifting the will, it means looking behind the company as a legal person, disregarding the corporate identity, that is separate legal entity, and paying regard with, that is paying attention to the realities behind the legal facet, means behind this curtain. Who all peoples are involved in the fraud in the company, in the management of the company, who are responsible for the act done by the company. These are being checked by the court in such cases where the court ignore the company and concern themselves directly with the members or manager. The corporate will may be said to have been lifted. Only in appropriate circumstances, the court are willing to lift the corporate will, and that too when the question of control are involved rather than merely a question of ownership. So basically, we're going to study the cases where corporate will has been lifted. So it is not lifted generally. It is lifted only when the question of control is involved rather than merely a question of ownership. Okay. Basically, we just don't want to see that who is owning the company. We want to see that who all are controlling the company. Because you might have heard the word significant beneficial ownership. That rule has came just to know that who is actually controlling the company, because sometimes the shareholder who is in front is not actually those person who are controlling the company. So this is basically done to know those person, okay, and whose control the company is working. Now there are cases when the corporate will is lifted. First is in certain matters concerning the law of taxes, duties and stamp, particularly where the questions of controlling interest is in issue. Means where the law of tax, duties and stamps are involved, in those cases the corporate will is lifted where the question is related to controlling interest. Okay, and where the companies form other companies as their subsidiary, means when there are layers of subsidiaries formed by a holding company, like it's a holding company, it has formed another subsidiary, it has subsidiary 1. Subsidiary 1 is an holding company of subsidiary 2. Subsidiary 2 is an holding company of subsidiary 3, and so on. Okay? So for this, we need to find that this is the controlling company. So to find that these all are being ignored, that is, a corporate will be lifted. Okay. So sorry for the erase, it is done by mistake, so you can reverse it and note it. Okay. Now the third point is where the courts find that there is a avoidance of welfare legislation. means when the company has avoided the welfare legislation, or when it is important for public point of view to lift the corporate will, then then the court will do that. Or if the company or any person in the company involved in any criminal cases, so in order to look behind that legal person to punish the real person who has convicted the offense, who has conducted the offense, so to find out that the corporate will is being lifted, and where the use of an incorporated company is being made to avoid legal obligation. That is, company is being just incorporated just to avoid certain legal obligation, or a shell company kind of thing is made, then this particular thing is done by the court. Next is types of companies. Under this, there are various types of companies. Like on the basis, we have classified these companies on the basis of incorporation, liability, members, on the basis of listing on stock exchange, and on the basis of control. So, on the basis of incorporation, companies are divided into two parts, that is statutory companies and registered companies. And on the basis of liability, it is divided into three parts: company limited by shares, limited by guarantee, unlimited company. On the basis of members, it's one-person company, private company, and public company. On the basis of listing, listed company, unlisted company. On the basis of control, it's subsidiary company and holding company. So right now I'm giving you just brief, and then we'll be studying it one by one in detail. First is on the basis of incorporation. As I already told you, the company needs to be incorporated under Companies Act 2013 to get it governed by this act. Okay, and such company is called as registered company. And what are statutory company? Which are governed by any special act, especially banking companies that are regulated by Banking Regulation Act or RBI, or insurance company which are regulated by IRDA. So on these kind of thing, or LIC, so on these kind of companies, basically Companies Act does not apply. Wherever it is mentioned, it is applicable, but generally the special act which governs this particular companies, this is only applicable on this type of companies. Okay. On the basis of liability, the company is divided into three parts: company limited by shares, guarantee, and unlimited company. Company limited by shares, I had already told you in starting. It means a company which in which the members are liable to the amount of shares they had agreed to subscribe. Okay, and company limited by guarantee, it is of two types: having share capital and not having share capital. And if it is having share capital, company limited by guarantee, having share capital, then the members will be liable to the amount of shares which is subscribed by them. Also, they will be liable for the amount that they had taken as a guarantee, that they will going to contribute to such amount in the event of the wounding up of the company. So there is a twice liability of the members in this case. And in second case, company limited by guarantee, not having share capital, there will be only certain amount which will be guaranteed by the member in the memorandum, that in the event of winding up, it will going to contribute to a certain amount towards the assets of the company. And third is unlimited company, where the liability of the members are unlimited. The third is on the basis of members, that is one-person companies where only single member is there. Private company where minimum 2 members are required and maximum 200. And in public company, minimum 7 members and maximum member can be infinite. Okay, there is no limit. And on the basis of listing on stock exchange, we all know on stock exchange companies got listed. So if they got listed, they are called as listed companies. And if companies not get listed on stock exchange, they are called as unlisted company. On the basis of control, we'll study that in later. You're not going to understand in the short. So, on the basis of incorporation, statutory companies and registered companies. It is divided into two parts. Statutory companies I already told you, so nothing much in this. Okay, you can read it by yourself. It is very easy, but I'll just read it for you. Okay, these are the companies which are created by special act of legislature, RBI, SBI, LIC. Okay. And these are mostly concerned with the public utilities like railway, tramways, gas and electricity companies, and enterprises of national importance. The provision of Companies Act 2013 do not apply to them unless the Special Act specifies such application. Banking Regulation Act 1949 is a special legislation concerning banking companies. Okay, so I had already explained you enough about these companies to you. Now next is registered companies. I had already explained this. Again, I am reading it for you. These are the companies which are formed and registered under the Companies Act 2013 or were registered under any previous Companies Act. Okay. Just remember section 2 clause 20 of Companies Act. Now repeat the section with me whenever I say about any section. Okay. So, where the company is defined, it is defined under section 2 clause 20. Okay. Now, on the basis of liability, the company limited, it is divided into two parts. Company limited by shares, limited by guarantee. Again, I have told you, but it's a legal language, legal definition which is given here. So, we'll go through that. Section 2 clause 22 of Companies Act defines that when the liability of the members of a company is limited by its memorandum, means where this word limited and unlimited is written, where means how the company, you get to know that what is the liability of the company by reading its, by reading its memorandum. Okay, by reading its memorandum, you will came to know that whether the company is limited by shares or limited by guarantee. So, what it's written, when the liability of the members of a company is limited by its memorandum of association to the amount unpaid on shares held by them, it is known as company limited by shares. Okay, and it thus implies that for meeting the debt of the company, the shareholder may be called upon to contribute only to the extent of the amount which remain unpaid on his shareholding. Okay, we all studied in the accounts about call money, first call, second call, allotment money, all these things. So if any call is due, the member will be liable for the same. Okay, but if the shares are fully paid up, then member's liability will get finished. Now you cannot ask for any money from the member as he has fully paid up the shares that it is subscribed by them. Now, company limited by guarantee. Section 2 clause 21 of Companies Act defines this particular definition. It says that as a company having its liability of its member limited by the memorandum to such amount as may be the members may respectively undertake by the memorandum, is the amount is written in the memorandum that they will contribute towards the asset of the company in the event of being formed up. Thus, the liability of a member of a guarantee company is limited up to the stipulated sum mentioned in the memorandum. Members cannot be called upon to contribute beyond that particular sum. Means the liability of member is up to only that stipulated sum, the sum which is mentioned in memorandum, nothing more than that. Okay. Then third is unlimited company. Section 2 clause 92 defines this. And it is said as unlimited company means a company not having any limit on the liability of its member, means where the liability of members are unlimited. And in such a company, the liability of members ceases ceases when he ceases to be a member. Means we had already said that if member want, he can transfer his shares. After transferring their shares, he is no longer the member of the company. Is he still liable for this particular liability that has been written in memorandum? No. So what is written here, that in such a company, the liability of a member ceases, that is come to an end when he ceases to be a member. Means when his membership ends, his liability also ends. And when the membership will get end, when he is dispose of his shares, all the shares he held in the company. Now, liability of each member will extend to whole amount of company's debt and liabilities, but he will be entitled to claim contribution from other members. Okay, in the event of founder. Now, next is on the basis of members. How the companies are being divided. We have already said it is OPC. Okay, OPC, private company and public company. But just because it is on the basis of member, I am saying this. But otherwise, if I talk about the companies that we are going to discuss further, all the companies will come under only two categories, that is private and other is public. No company will go beyond this. Okay, private and public. You can note it on a blank page on back side, that which companies are private company and which will be a public company. See, no company will fall beyond this category, irrespective of whatever the name of the type of company is. Okay. So first we'll talk about OPC, that is one person company. Again, it's a private company. It cannot be a public company, because here only single member will be there who will be incorporating this particular company. Only one member or one shareholder will be there in this OPC. Only one member will be there. So the concept of OPC has now been introduced in India through Section 2, Clause 62 of Companies Act 2013, thereby enabling entrepreneurs carrying out on the business in sole proprietorship form of business to enter into a corporate framework. Through this concept in India, though this concept is new in India, but it is already a part of many other countries like China, Australia, Pakistan and UK. So means it is basically a benefit to sole proprietors who are afraid to form a company because they think there are various procedure and provision that they need to follow. So this is an escape route for them. Only a single person can incorporate this company, and there are n number of relaxation which is given to this particular kind of company in the act. And by doing this, he will get all the benefits that we have studied of incorporating a company. Now, what the provision says about this? According to Section 2, Clause 62 of Companies Act 2013, one person company means a company which has only one person as a member. Okay, it has only one person as a member. No other person can hold membership in OPC. Only one person can hold, and that is also has a condition that who can be the member. We'll see it in the further slide. Then a company formed under this OPC can be either a company limited by shares or a company limited by guarantee. A company limited by guarantee. Okay, and unlimited company. We had already discussed these three. Then one person company is basically I had already said it's a hybrid of sole proprietorship and company form of business, and it has been provided with various relaxed or concessional requirements under this act. Now, there are certain provision regarding this. Single member who can be the member of the company, OPC, that is, only a natural person who is Indian citizen and who is resident in India. Natural person means human being. A company or a body corporate cannot be its member. Okay, resident in India means a person who stayed in India for a period of not less than 182 days in immediately preceding calendar year. Like if you are incorporated the company OPC in 2021, so in 1920 that member must stay for at least 182 days. Okay, and the if a person who complies with these three conditions will be eligible to incorporate a OPC. Okay, and what is and also one other more important provision for this, because there is only a single member. He may die in future, he will die in the future. Death is the most certain thing which is there. So as the company has a feature of perpetual succession, as you remember in the previous class I had told you that. So to comply with that feature, it is made as a mandatory to appoint a nominee for the member. So the nominee also need to comply these three conditions. That is, he must be a natural person, an Indian citizen, and a resident in India. So that person can become the nominee for the member, and in case the member dies, the nominee will become the member, okay, of that OPC. Not only death, in case of incapacity of an original shareholder, if he got insolvent or it becomes of unsound mind or something like that. Okay, and such nominee shall give his consent in form INC 3 to being appointed as a nominee for the sole member of OPC. Now again, this is the criteria which is given. Okay, only a natural person who is Indian citizen and resident in India shall be the nominee for sole member of a OPC. The next point is a nominee will be permanent, or we can change the nominee if it is required. So yes, a nominee may withdraw his consent. Also OPC, that is the member, can also change the nominee that he has appointed. How to change that? By giving a notice in writing. How to change, we'll see in future. How the nominee will withdraw? He will be withdrawing by giving a notice in writing to sole member and to OPC. Okay, and sole member then nominate another person as his nominee within 15 days of the receipt of the notice of withdrawal. And also, if he wants to change any particular nominee, then he will have to give notice to ROC within 30 days in INC 4 that he has changed the nominee. Okay, within 30 days of such change. And for withdrawal, within 15 days, that particular nominee will give his consent of withdrawal to the sole member and to OPC, and then OPC within 30 days will file INC 4 to ROC by nominating a new person as his nominee. Now, we have talked about the number of members in OPC, but what about directors? There can be minimum one director in the OPC, which can be that sole member also, and maximum director limit is same as of other companies, that is 15 directors. Okay. Now, other features. One person company cannot incorporate more than one company, one OPC, or become nominee in more than one OPC. That is, one person cannot incorporate more than one OPC, and one person who is appointed as nominee can be the nominee of only one OPC, and no minor shall become the member or nominee of the OPC, or no minor can even hold a share with its beneficial interest. And third is, no such company can convert voluntarily itself into a company unless 2 years has been expired, or in case when the threshold limit has been crossed. What is the threshold limit? I have written it here. Paid up capital of OPC should not exceed at any time beyond 50 lakhs, or average annual turnover shall not exceed 2 crores immediately preceding 3 consecutive years. Okay. means we'll see 3 consecutive years. Immediately preceding 3 consecutive years, these things should not get exceed. If it exceeds during 3 preceding consecutive years, consecutive year means 17, 18, 18, 19, 19, 20. So in all these years, we'll see whether the threshold limit has not been increased. If it gets increased in these years, in any of these years, then the company has to, OPC has to convert itself into other kind of company, that is private company or public company. There are certain privileges which is given to OPC. These are, one second. Most significant reason for shareholders to incorporate it is because it has limited liability, okay, and the business currently run under proprietorship models could get converted into OPC without any difficulty. So what benefit you will get? OPC, on becoming OPC, you will get separate legal entity. In sole proprietorship, this is not there, okay. You have the whole ownership or whole liability. Again, liability gets limited. Here sole liability, and taxes in the same manner as the private company is there, okay. Here lesser tax simplification, here taxes are more, okay. And here succession through nominee. Here if the sole proprietor dies, then your OPC will also die. Sole proprietorship will also die. And if the sole proprietor, that is a member, single member dies, nominee will become the member, but OPC will never die. Now, OPC must file annual return. Only annual return and certain other major compliances need to be done. Here, in sole proprietorship, you need to get your accounts audited under Income Tax Act, and once turnover cross certain threshold, then only you need to make your accounts audited, okay. And here account need to be audited every year before filing it, the annual return. Okay, so there are certain prohibited activities. What are they? There are such OPC cannot be incorporated or converted itself as Section 8 company, and such company cannot carry NBFC, that is non-banking financial investment activities, as an OPC. If it wants to do any of these things, first it needs to convert itself into either public company or private company. Then it can become a Section 8 company, or it can carry out the business of non-banking financial investments. That's all with this particular video. From next video, we'll be going to discuss private company, public company, and various kinds of company, okay, in detail. Thank you. And please revise whatever we had studied within 24 hours before watching the next video. We'll be discussing the further chapter in coming video. Thank you.